Today is going to be, I'm going to do some big picture. I am going to get into resources because I want everybody to feel empowered. Do we know everything? No. And it's impossible. Why? Because annuities in financial services, all of this, even from final expense, it's a moving target. The apps change, the products change, qualifications change. So the point is, I want you to not be afraid of annuities. The very first thing that I wrote when I got my license, my very first thing I ever wrote was an annuity. I didn't know any different. I It was one of my little grandbaby's teacher, and she said I need some help with my retirement and some insurance and all that. She said, "Could you help me?" And I said, "Well, when I get licensed, I can. I haven't taken the test yet." So I got licensed and did annuities. And it really is, I want to let you know that what's really great about this is we all know people that can benefit from an annuity. It is not a one size fits all. I'm not going to do deep dive into product today. I think because here again we have another new carrier coming on that's going to that's going to fit a niche for us with the AMAM in a simplified issue. But big picture, what's happening, and if you do any kind of get on YouTube or social media, you're aware of what they call peak 65, and that's a big thing in the market. And that just means from 2024, 25, at the end of 2024, so through 25, 26 through 2027, this is when like 11,000 people are turning 65 every day. And this market, annuities, March of last year, March of last year, the most annuities premium was written ever in the history of the world last year, last March. And we're just coming into this. So there's a lot of money that people have to get retirement income from. And why is that? It's because the baby boomers, they have 401ks, but they don't have income. And I know that sounds like an oxymoron, but they're looking for ways to grow, asset preservation, asset accumulation. So I want to paint the picture for you that we have through 25, 26, and 27 to be asking people the simple question, whoever you're talking to, do you have anything that acts like life insurance? Do you have a 401k? Is it protected? Simple questions can, oh my gosh, my husband and I were just talking about that. So realize that asking questions is going to open the door for you. Now, in people that are buying the IUL leads, we have seen that IUL leads are some of the best leads for pivoting to annuities because IUL, you need health, you need good health to qualify. Annuity, you need wealth, whether it's qualified funds, meaning that it's tax deferred, sitting in an old 401k. Most people, if they're still working, their companies won't let them always pivot that money. They have to, it's usually what they call an abandoned 401k. But you can talk to people and there's a lot of people on there that have gotten niches. Like Felipe really was pursuing teachers, and that is a niche that's very unique to itself. We have a lot of retired people now that have 401ks that they want to get the money out of the volatility of the market. They want asset preservation. Digging deep on that, they want asset accumulation. They need to make money to supplement their retirement. And then that's a deep dive. It doesn't need to be, lifetime income, or are they looking for accumulation and roll it over into something else? So we'll get into some of that, but I just want you to know that I get very excited about it because we can help customers that are currently our own customers, like your old book of business, former leads, your neighbor. I was just helping, I'm helping our neighbors. I talk to them, and just a simple question of, well, do you have a life insurance policy? When was the last time you reviewed it with a licensed agent? Let's set a time to do that. And it has led into annuities. Okay. So just ask questions, being helpful. That's what we do. So, there's a lot of new people on here. So some of this is going to be repetitive, but I really want to empower the agents to understand the tools that we have so that you don't, yeah, you have wingmen, wing people, you have help. But listen, I'm going to try to share this. So Neal, let's see. I'm really not good at, okay, if I hit share, and can you all see that I'm on Gateway?
There you are.
Okay. Okay, this is really where you want to start. If you want to start with annuities, this has become just a really great resource. First and foremost, if you think you're compliant, like I had a gentleman, an agent say, well, I wrote an annuity. I said, well, when was it? He said, 10 years ago. I said, well, is your license current? Have you done suitability? If you go into Sure LC, and I'll show you some of these, what it should look like. If you go into Sure LC and you're doing IULs and all that other stuff, you go into continued education and training. Okay, when I changed my screen, did it change with me?
Yeah, it's keeping up with you.
Okay, so you can see, okay, best interest. I gotta move this. Okay, best interest. Okay, all of the licenses that you're going to write annuities in, your best interest should be green and your annuity state should be green. You can see down here, LTC, long-term care state. I don't do that. So the point is, if one of my states was up here in annuities was yellow, I need to click that state and go down and see what specific training I needed for that state. So this is kind of your scorecard. The only thing that's really unique is California. You have to take state-specific training every year. It's 8 hours of suitability. It includes the best interest. It is its own little standalone. Most of these others have a reciprocity program, but this is just a really good place to see if, in fact, you're compliant. Okay. And as I go through, if people have questions, ask them, because I don't want to confuse anybody. All right, so back to, I got to get out of this. Back to, let me, and the recording thing is blocking my, I can't see.
Yeah, you just got to constantly move it around.
I can't, where it says it's up there, I can't do it. Let me just close. Oh, I didn't want to do that. All right, so I can't, it's your recording bar.
Yeah, just grab it. You should be able to move it.
No, it won't. Okay, so here, let's do this. All right, so when you're annuity resources, this is really, it's small, but it's really good. You have the financial inventory sheet here you can download. If you get on the annuity IUL training, Frank Eufema has sent out a little bit different version of that. But the client inventory sheet, you need to be filling out with everybody you're doing, and you ask the golden question about that. But there's a financial inventory sheet. Your annuity training, again, these are most of these were done by Sean Ruggiero, and it's the basics. It's really the basics. And what is an annuity? These are very short, 10 minutes, 5 minutes, 3 minutes. Go through some of these, and because the whole point that we need to make sure is if they get that phone call from the carrier for a suitability confirmation, the answers that come out of our clients' mouths need to really be lockstep with what we're trying to explain. Does an annuity have a guarantee? No, there is no guarantee. We eliminate the risk of loss. Once you have a gain in an annuity, you can't lose that. It's like an IUL, you don't lose the gain. But I cannot guarantee what the market's going to do every year. We don't have a crystal ball. So they have to understand that. And that's video 7, elimination of market risk. So this is just a really good resource here. Finally, on I don't want to use that one. I want you down here, ask a specialist. And we've talked about this before. This is a really great way to just for everybody to log on if you have somebody that and I like people to know. I mean, I've helped many agents, and Alicia was like, well, you're going to help me. Why do I need to do that? Well, she really wanted to focus on this, and I really wanted her to know what other resources we have. So again, you just fill this out, hit annuity. You have to know your client worksheet. You have to know their financials. What's their net worth? What's their ratio, their debt to net worth ratio? What's their expense to income ratio? How much of this annuity is going to be in their retirement program? Is it 50% of their net worth? Is it 30% of their net worth? You have to know those things based on the carrier guidelines. And every single carrier has a guideline. You need to know where to get those on Athene, on National Life Group, F&G. Those are really the underwriting carriers that do like IULs. You should know how to accept. Athene just does annuities. You should know where to find that for the annuity too on
Hey,
the
and Jay,
underwriting. Yeah.
and Jay, just to let everybody know what you're showing here. I mean, you keep saying, "Hey, you got to know this, you got to know this," but when you're just starting and you don't know, that's what this resource is for, because this is going to help. Now, as you said, you need to know that you need to ask those questions from your client
That's
about
what's
their, so you can fill that out as accurately as possible. So I just wanted to interject that.
yeah, thank you. That's the inventory sheet. That's the inventory sheet that gives you kind of a snapshot. And then again, you go on Athene because you get contracted with Athene. I'm going to go through those steps. You get a suitability guideline. That's how we learn it. They have everything to coach us. And again, I help agents tackle those steps. But if you don't have anybody that you're working with, but you want to know where these resources are, this is the time to go find them. Get on Athene, get the suitability form, get on your gateway, print this client worksheet, go through the videos. This is how you get ready, because you want to be prepared before you talk to somebody. And that's just like you want your licenses to be green before you try to write an application. Because if you don't have annuity training or best interest, you cannot write an application. So I'm trying to give you the resources to devour now before you talk to somebody. Does that make sense? I think I jumped ahead a little bit, but that was my intent, is give you resources now so you can be prepared. But Gateway they've really stepped up what they have there. So that's just a really good resource. Okay, so thank you, Francis. Any other questions on that from anybody?
Hey, MJ, Felipe downloaded the worksheet and then uploaded it to the chat. So anybody
Oh,
that
he's
wants to
so
download that,
awesome.
yeah, he is.
That's awesome. Okay, so that's the Ask a Specialist. That's all that stuff. Worksheet. All right. And then, yeah, I was actually going to go through some of that. Again, I don't want to get too, and this is a great resource. If you want to know what's going on, register on LIMRA. They talk about the annuity markets, a deep dive into stuff. It will really, it's not advertising. It's facts, it's research, it's trending topics, but that really has been a good resource that I like to go to. Okay, so let me get back. All right. Let me see what I have got a little outline here. Okay, stop screen sharing. Okay, so carriers. We have carriers that we work with, and it's not a one size fits all. When you get contracted, Leanne really goes through that, why we have Athene, why we have National Life Group, why we have F&G. Those are the fully underwritten annuities. Then we have the simplified issue like IULs. You're going to pivot. So it's important to have your carriers ready before you need them. So if you don't know if you have it, call the carrier, ask them if you have an active contract, and circle back with Leanne and say, these are the ones I need. Okay. But I think when you understand, if somebody doesn't qualify on the IUL because of a health issue and they have money per month or lump sum, then get the information, let them know you're going to talk to your product specialist, give me a call, and we'll figure out a strategy. What's the best way to proceed to help them park their money in the safe money account? The big thing you need to know is it qualified, meaning pre-tax, or is it after-tax dollars? Is it coming from a savings account? That really is the only technical thing you need to know. And then on illustrations, on illustrations, it seems like everybody kind of wants, what I'm finding is everybody's like, oh, I need to show this person an illustration, and they really don't know what the person's looking for. Meaning, are they going to need income at some point from this retirement? Okay. And I've got some points on it's called how to write better business. There are just some really, really easy bullet points that will help you in terms of knowing, okay, where should I pivot? If somebody is under 59 and a half, like they're 40, and they want to roll over a 401k, you're never going to put it in an income annuity. Why? They're 40. You can't have income on an annuity until after you're 59 and a half, or you get penalties. So you won't. And why is that important? Because they're paying for an income rider. Okay. So just want to be very specific. If they're way under 59 and a half, they're in their 40s, early 50s, you're just going to do a cash accumulation. You want to asset preservation, okay? So kind of make sure you know that if they say they need income, so you can put them in a 10 or 15-year growth product annuity. When that's fully annuitized, year 11 or year 16, then you roll it over into an income annuity. Does that make sense, everybody? It's not a one size fits all or a one product necessarily. The big thing that I really want to have people understand is where we get scrutinized with annuities is when somebody has an annuity that they're not happy with. Maybe it hasn't performed with company XYZ. That is, there are additional steps we have to take. There's a replacement form. And basically, just understand the reason our industry is very scrutinized is because agents before us were taking little old seniors' money, and they didn't really have a lot of liquidity, and they locked them up in an annuity for 10 or 15 years where they did not have access to their money, and they got penalties for taking money out that they really shouldn't have. So it really gets scrutinized if you're replacing an annuity, because it can't just be, well, this didn't perform well. Okay, is it in a variable annuity? Oh, yeah, it's in mutual funds. Great. Now we can take it out of that. We can eliminate risk of loss. Now we can put it into an indexed annuity that puts them in a better place. Do you see how that benefits them from replacing it? It's not just taking them an indexed annuity and putting it over here so you get a commission. There really has to be a good, valid illustration of why we're taking them out of a product and putting them in a different annuity. All right. So does everybody understand that, what a replacement means? It's if it's in an annuity, going to annuity. That's not the same as a 401k. That's a rollover. So in that, they will also look at companies will work with people if they're getting penalties like up to 2%, like a surrender fee for rolling that over. There may be a gray area 4 to 6%, but if somebody's really getting clobbered with a 6% surrender fee or charge, you really have to be sensitive about that. That's one reason why that performance bonus from Athene is helpful. If they're getting a performance bonus, it's the net surrender that they look at. So keep that in mind. Have an idea of, you need to have an illustration in their old policy, what they have, so you know how to give them advice without getting penalties or getting declined.
Hey, MJ, what are those rollover bonuses running these days with Athene?
Well, then they do vary. Yep, they vary from the 10-year to the 15-year, and from the regular like the 10 Performance Elite 10 and the plus. But you can get anywhere on average 14 to 18, 20% premium bonus on what you're rolling over.
Okay.
or lump sum, like if they're money market or savings or something. Um, there is now, and this is all basic. This is all really basic annuities. Neal, you had a really, really, really good. We're really actually moving into what I'm going to call a higher level of annuity in terms of where people have more than, three, four, 500,000 that they're rolling over. They're looking at, they have, $1 million, bigger numbers. And it's a mindset that's happened in the market because of this peak, what they call peak 65. And I'm going to see if I can get that. I really would like to play that
Oh, that
video.
video?
Yeah, it's super. It explains things better than I can. Um, Here it is. This one. And if y'all
The premise in a fixed index annuity is that you're getting growth with market increases with zero risk of loss.
Honey, you got to share your
Possible.
screen.
It seems too good to be true, but there is
Okay.
some science behind it. So
let me share. Let me share.
And then under the more tab, you'll share your sound.
Okay, so can you guys see the gentleman standing there with glasses?
Yep.
All right, and you couldn't hear him?
Well, under more, just
Yeah.
click on more, and then it should have sound, and then share your sound.
All right, let me try and see if I got
that's the money that you set aside to provide for yourself some retirement income. You've decided that you don't want to have all your money at risk in the market. You're tired of taking the losses. And so you've heard about this concept of a fixed index annuity that gives you some growth with zero risk. So you've got your money here that you've set aside for income. You transfer that money to the life insurance company. And then what they're going to do is they're going to take your money and put your money into a pool of long-term bonds. Now, they're not purchasing bonds for you. They're just adding some more or buying more bonds with the money that you put in. And that's where your money stays. And that's important. Your money stays right there in the bonds. Now, most of the companies that provide these types of annuities are very large companies. They've got hundreds and hundreds of billions of dollars in these bonds. So they're always getting a really good interest rate off of them at any given time. And so at any moment, they're drawing interest off of these bonds. Now, the life insurance companies are required by regulation to demonstrate that they're going to do business in a way that they will remain solvent, that they're going to be able to pay their bills. And so because of that, the first bit of the interest goes right to them. That's going to keep the lights on. That's going to pay the salaries. That's just going to keep everything nice and solid and strong. And so that little bit is what they're going to use to do that. But it's with the rest of the interest, the majority of the interest that they're drawing off of these bonds, they're going to use it to provide that safe growth. We call it indexing. It's within a fixed indexed annuity. So they're going to take the interest and they're going to purchase index options, not necessarily stock options, but all indices have options just like stocks do. And it can be a variety of different indices within the account. These different companies provide different ones, S&P 500, NASDAQ, whatever. But let's just say you purchase, they're going to purchase options for a particular index. Well, then what happens if the index goes up? The market goes up, and just like with Starbucks, they're going to exercise those options. The first sliver of the profit from exercising the options goes right back to them. There's a reason why these companies have been in business 300 and 400 years is because they know what they're doing and they can make some profit along the way. So the first little bit goes to them, it adds to their bottom line. The next sliver of exercising the options goes into what we call the pool or profit pool. We're going to talk about the profit pool in a little bit, but really this is the cash on hand. This is what they use as reserves. One nice thing about life insurance companies is they always have to have reserve money to satisfy all of their obligations. So they're going to keep that money in the pool to satisfy those obligations. Now, it's with the rest of the money, the majority of that profit from exercising the option, that goes into the customer's account. They get a nice deposit showing up, when they check their balance. So that's the first half of the equation. How do you make money if the market goes up? Well, that's the easy part. The real question is, how do you not lose money if the market goes down? Well, let's take a look at that. Let's say the market does go down. The index is lower. The index is selling at a price lower than what they purchased the options for. And so if the index is low, will they exercise the options for the index when the index is down like that? They're not going to do that. So what happens if they expire? They lose those options that they use for the index. But what money did they spend to buy those options? They spent the interest, just the interest off of those bonds. Now, what is very important to know is that their customers' money is still in the long-term bonds. It never left. Notice there's no fancy arrow going from long-term bonds into purchasing the options. They never touch the principal. They only risk the interest that they're drawing off the principal to purchase those options. And so that's how, if the market goes up, you're getting growth in your account, but if the market goes down, you're not suffering any losses.
More and more these days, annuities are becoming an asset class. A lot of times we work with individuals and look into their portfolios. They have $5 million, $10 million, $15 million, even $50 million in liquid investable asset. A lot of times high net worth individuals, they look into the direction of annuities these days, more and more so. Why? Why are they diversifying themselves from the traditional stocks and bonds setup? For one, if they only use 20 to 30% of their portfolio to really protect their lifestyle, they don't necessarily need annuities to generate income. But if everything goes wrong in the stock market, if anything, we now these days understand anything can bring down the stock market overnight. So if anything were to happen, they have this portion of money that they never want to lose, and they can guarantee themselves lifestyles that their family don't necessarily need to lose. They not only understand how to build wealth, in retirement stage, they do understand the importance of protecting the wealth and distributing the wealth and building the legacy the right way.
All right. I just thought that puts us in a different category, understanding, because we are talking to people like Brian Cagney. You know, from your background, you talk to high net worth people. They understand how annuities work. So we need to understand how annuities work. Do we need to always explain that to everybody? No, but we need to be confident that what we're doing is putting into something either for asset preservation or asset accumulation. Because it's important that if somebody's following your recommendation on what product to go into, it's going to protect it and it's going to grow the way that we're illustrating it. Okay, the last thing I have is a lot of you, because most of you are all doing IULs and you have the IUL presentation. When I work with somebody that's not doing IULs, maybe they're doing final expense, I have an annuity presentation that I use, and it almost looks like the IUL presentation, but we do have that that can be customized. All you do is drop in your license. I mean, I don't know if you need me to go through that. It's very short, but.
Well, MJ, how about this? When we send out this recording, we'll do a link to that annuity presentation, and then we'll do a link so people can download that video we just played.
Okay. Well, and again, just resources. I want people to know we have resources. Ask, you know, that's all we want to do is just,
Well, hey,
you know,
MJ, can you show your presentation?
all right. So basically just going through, and then my little thing is in the way, so I can't see it. So I've put on my state and I go through, you know, Dan Hatcher went through his presentation last week. I do the same thing. You want to go through everything and say, okay, this is my license. I'm a resident, or this is my resident state. I have 26 licenses. Here's my NPN number. This is like your driver's license, your social security. Feel free to write this down. This gives me the authorization to work with you on these products. Not everybody's licensed to sell fixed indexed annuities. It is a unique niche within life insurance. Not everybody can do that. So I really explain that quite a bit and go through it. Okay, so what is this fixed indexed annuity? So what you're talking about is you've got a dormant, an abandoned 401k. It's been up, and then there's been times it's gotten clobbered, but you're 60 years old. You don't have time to make up that loss if something happens in the next, you know, couple months, years. So what we're looking at is rolling it over into what we call a safe money account. All right. Why aren't you putting it in a bank? Because banks don't have to have the assets to back up their business. Where do the banks put their money? A lot of it in insurance companies. So we're going right where the safe money is. And again, it's all to protect you from the volatility of the market. So you're probably aware of what you have your 401k in. It's in mutual funds. Some are in variable annuities. Okay. There are also fixed annuities. Those are for people that only want a certain small amount of return and they're happy with that. What we're going to talk about is the indexed annuities. And that is where it participates in the gain of a market. And as we've explained, this just shows a really nice, and again, as you guys can see, I go through what the IUL does. This is what the IUL does, but an indexed annuity is the same thing. When the market goes up, you participate in the gain, locks it in. When the market goes down, you do not lose a dime. You do not lose a dime of that. That's why we say zero is hero. There is a zero floor. You never lose money from your gain. And when you look at what there's many different indices. Every different company has different indices that they can invest in. We'll look at that, but everybody knows the S&P 500. Pretty much long term, the indexed annuities outperform anything. If we have got the lock in and you're going long term with an index like the S&P, because it's not a roller coaster up and down. You've locked it in, and we call it baby step. You step up your portfolio. This is just another way to look at it, kind of laying the different lines over what a fixed strategy is, what the market has done, and what the index strategy is. And starting out for a 20-year period, basically looking at if you had $100,000, what each one would be in. And this is basically 18 years. But it shows how an index strategy in an indexed annuity has outperformed because you're not playing catch up from those market losses. The benefits in annuity. Okay, so what you told me is you want principal protection, and basically you want to leave a legacy that avoids probate. These are additional. We have the tax deferral. That's why you have the 401k. It's a tax deferred. You've got the growth potential. We do have products if you need to turn on an income to have lifetime income. So many people are fearful that they are going to outlive their money. So if that is something we need to look at, that particular product, that's why we have that as a benefit too. And then some, not all, some products and some companies offer premium bonuses where they give you a little monetary bump to be included initially from day one in your crediting. They'll give that to you, and then it's vested over the number of years that your annuity is until you're fully annuitized. And we'll go through that in an illustration. Again, this is just talking about why people aren't putting money in banks. They really don't have the confidence. And there are a lot of banks that have been closing in the past, actually 5 years. Types of money that you can roll over, 401ks, 403bs. I mean, we've got lots of different things. Your Roth IRA might be that's after-tax dollars, your savings after-tax dollars. So you have a benefit of having two different types if you want to have like tax-free retirement income, or if you're rolling it over tax deferred. So we can accommodate both of those. And what's nice is one of our lead companies that's premier in this has been awarded for their product as the best index product of the year by their peers. And that's the caliber of the companies. We deal with literally the highest rated annuity companies out there. And that's what's important, is because when you want your money to be there, you want to make sure the company's been there. And most of these companies that do annuities, they've been around 200, 300 years. These are not mom and pop shops that opened up last week. And again, I go through a little bit more of that, but it's important that they understand, I don't want to spend way too much time on that because you guys can put your stories in there and stuff, but that's the basic of the slideshow. It gives you your talking points. Does that make sense? I know I go through things fast.
No, that was perfect.
I'd love to hear Alicia and Felipe, and I mean, they would be so awesome at this. I just want to kind of get through this a little bit fast and give the new people the tools, right?
I think you've sold the most annuity on a team. I've done 145,000 last year. But I think you did, I don't know how much annuity you did last year.
My goal, well, Neal knows my goal. My goal,
You did that. You've done the most. I think you've done the most on a team,
Well,
hasn't she?
Oh, no doubt she has.
well,
Yeah.
again, and they're just they're not always big. I mean, I'd say my average is 100 to 200,000 on annuity. I've never done one bigger than 350. I haven't done $1 million annuity yet. But I am ready. We've got the resources, and that's what I want y'all to feel like you have too. We have resources, so when that customer presents itself, they trust you, and that's what we want is we want you to have the resources so you look like the expert. So you understand you're using the same words, yes, the S&P 500 index, but there's many different indices. We want to make sure we're using the right language when we're talking to this client.
Yeah, and there's big money comes in camouflage packages. And we told the story about we were talking to a guy, he's 73, he wants an IUL. And I said, well, do you have anything else that acts like life insurance? And he goes, well, I've been with my company 50 years. I've got a pretty big 401k. And I said, how big is it? And I forget if it was 823,000 or 723. And he was looking already to get it out of the market.
Yeah.
So there's
We had a whole strategy where some went into an annuity. We had to do liquidity. We had to do some. So, we laddered products, but the point is it was a big picture. We had to get the kind of the big picture before we got into individual steps for him.
But the point is, I ask the questions, MJ does the annuities. You need to ask the questions. We'll find somebody to help you do the annuity. That's the point, right?
Well, you're going to do it. You're going to write it. I'll be in the background.
No, you're going to write it. Hey, Felipe.
No, we do it together. We do it together.
Exactly. Felipe, you have your hand up. You had a question.
Yeah, I just wanted to mention. Can you guys hear me?
Yeah,
Yes.
we can hear you now.
Just wanted to mention, MJ. I remember you since you're talking about resources. I don't know if you want to mention the Firelight, the Firelight application. How the FFL Firelight.
Yeah, that's on and a lot that most people do that with when I go through when I'm helping an agent, I get them to Firelight because they're like, hey, where do I write an app? And it's like Firelight, but what we can do, there's Firelight Direct on the application, and Felipe, we've changed it a little bit. So what I do is I'm really with the agent on the call. We're figuring out what's the right thing to do, and when it is time to write, we're writing it on the application, but we're using the Firelight that is tied to the carrier.
Oh, gotcha.
And because it saves the application, and we can scrub it if we need to. Because again, we've got all the guidelines on what is the ratio. And I mean, I was just helping an agent do that today. He started an annuity. They're not always a one sit. A lot of times they have to go find their logins to their portfolio or however they do it. But there is a time we can scrub that before you send it in. And that's what Felipe's getting. There's a Firelight that will get scrubbed by SRS or we scrub it. The point is it never goes into the carrier without eyeballs looking at it to make sure liquidity is right, assets are right, you've checked the right box, they didn't check that there's a guarantee. They understand these things because we don't want it denied over a clerical error, basically.
Hey, MJ, let me, somebody asked this before, and it's an important point. You mentioned before you have qualified and unqualified. So qualified means taxes have never been paid on that product. So that's like a 401k that's dormant, moving it to trustee to an insurance
a thrift savings plan. If it's in a we've
403b,
303, yeah. If you've had your teachers, if you've had anybody that's in, but within those, yeah, they can have even in a TSP, and even in a 401k. Qualified means it's qualified to roll it over into the account and be tax deferred. They
Right.
won't
And-
pay taxes on it. Unqualified or non-qualified is really what it is. Non-qualified means it's after tax dollars. That's all it is. Like savings account, Roth IRA, you know.
Yeah, and the point is there's no tax consequence when you roll it as a dormant 401k into an insurance company. Just to be clear on that, no tax consequence. A lot of people think that that money has to come to the client.
No,
and
no,
he
no.
sends it in.
And
No,
that's what you don't. You never want it to come to the client or there will be a tax consequence. It has to go from institution to institution. It goes from Fidelity over to Athene. It goes, you know, that person never takes ownership of that money.
And then the other thing is when it's non-qualified, meaning taxes have already been paid, and you put it in an annuity, you only get taxed on the gain. You've already paid taxes on the principal. Just so everybody understands that, that's
Right.
pretty basic, but
Right.
let's
And
see.
what's really great about that is, again, you know, leaving a legacy. You know, you have the beneficiaries on there, so they get the death benefit if there's any money left over. If it wasn't a lifetime annuity, let's say it was just for asset accumulation, asset preservation. Well, those beneficiaries get that money. There will be a little bit of tax on the gain, but the insurance company, they take care of it. The annuity company, you know, does that calculation, avoids probate. It's immediate after the annuitant passes. I mean, I have been on a receiving end of it. I've been on one end of it and I've been on the receiving end. So I've seen how that works, and it's they do it right. And that was there was another question that
Yeah, about liquidity. And I think that depends on, are they talking about liquidity like in the video or liquidity as whether or not you can get access to your money in an annuity? I'm not sure what context.
Well, I think what he was talking about is that these companies are very solvent. They have assets to back up their business. They can't go make loans like a bank can make a loan, $1 million house, and they don't have the money in the back to back up that loan. The insurance companies have to have assets to equivalent a certain percentage over what their business portfolio is in. So it's very solvent.
So MJ, can anybody take out an annuity or are there requirements?
There are requirements. I ran into one today. I've never written one, helped somebody write one with as low as income that was there, but the ratios fit. So we'll see. We'll see.
What ratios you talking about?
Liquidity, do they have liquid assets, you know, backup money so they don't need to live off of this money? And then their debt to income ratio. And then so it's liquidity, and then it's basically looking at their assets. There's two different things we look at.
Suitability. Good word, Rocky. Thank you.
Suitability.
That's the key word. Yeah. Leave it
Is
to a
it,
guy.
is it a suitable strategy for that person? And then are they, you know, that's how I
And
explain
the
it.
last question I have is, can anybody with a 401k, a company sponsored 401k, can they move it into an annuity?
That's the tricky part. No, it's not across the board. If they are still working there, that is an issue with some there's a clause. There can be a clause where it says as long as you're an active employee, you cannot move money from our company 401k. There are companies when we've been able to move it over while they're still there. They've just said, look, the guideline is, you know, if somebody's getting a match, if they're getting an employee contribution, it really might not be in the best interest of that person to move that 401k over if that company's given a match. So it is a case by case, but what the cleanest one is if somebody's left a job, they started a new job, there's an old 401k, or they've retired. Military, teacher, government worker, whatever, those TSPs, the 401ks, those are fair game, and it really can make a huge benefit in saving their retirement if they don't like the market volatility.
Yeah, and you reminded me of something recently about the military. So when somebody's in the military for 20 years and they leave, number one, they've got to move their TSP, which is the trust, or I
Their
forget what the
thrift, their, yeah.
thrift
Thrift
savings
savings
plan.
plan.
Yeah,
Mhm.
so they have to move it. So number one, when you're
Well, they
talking,
don't. They don't. The military says, "Oh, just leave it here." That's the misinformation. They
yeah,
they they can, and sometimes they should move it.
yeah.
And
So number one, you get an opportunity to move a thrift savings plan.
Mhm.
And number two, they don't have a retirement plan anymore. So now, what are they going to do? Well, you can set them up with a retirement plan through an IUL. And then number three, they're losing all their insurance because for the most part, they have 450,000 while they're
but
active,
it's term.
but it's term. So when they
get-
leave, they're uninsured. So you really get three bites at the apple. One is to transfer a thrift savings plan to an annuity. Secondarily is to set up an IUL. And then third, you can set up a term policy to replace the insurance that they might be losing. So it's really good. Rosina's asking about what is the debt to income ratio of what is a debt to income ratio that's suitable? In other words, when you're looking at 100 grand, what are they going to need to have outside of that 100 grand in order to qualify?
Well, that's where the worksheet comes in, because you do have to look. You've got to look at. I mean, they don't. And there's rules of thumb. I mean, every company's a little different. I think Athene tends to be. Then actually, they've eased up a lot of their. Let's see, a little question mark next to the liquid.
So
Um,
Rocky's saying it's about 70-30 depending on the carriers.
It depends on the carrier, and it kind of depends. Yeah, they don't want that annuity of their liquidity. They really don't want that annuity to be more than 30% of their am I
Total assets or
of a portion of their asset. Right, right. But again, it kind of depends on they look at that ratio based on what other assets they have. But that annuity can't be 100% of what their
yeah.
liquidity is. They
And
have
Athene are they still a lot tougher on suitability where National Life Group is very easy on suitability?
Yeah, I would say that's a fair statement. Athene has actually eased up and made it easier. Made it easier for people to qualify, and the application has changed. They have the worksheet, but it's on the application. It's just more like kind of what you see on National Life Groups, the boxes, and they're quirky. There's just all those applications are a little quirky, but it's definitely gotten easier. But I say National Life Group is more lenient on their ratios
Perfect.
on the annuity. That's my feeling. And Felipe was nodding his head too.
Awesome. So any other questions? We covered most of them in the chat.
Yeah,
There,
don't be afraid to ask people. Hey, do you have a 401k? Or hey, how's hey, your retirement? How's that going? You got a retirement? Oh, I just messed up my camera.
your camera is looking at the lamp.
Well, because I was talking with my hand. Saw a slide over. Yeah, so I just ask the questions because people are hearing about it in social media. They're hearing about it and they don't know who to talk to. They really don't. And if you're a friendly acquaintance and, hey, I can get you information on that, that they're just looking for help.
Yeah, the last thing I'll share with you is that I was talking to Brian tonight from Phoenix. When it's very dangerous to talk to two people or talk about an IUL and an annuity to one person in the same meeting. I mean, you want to bring up the concept of an FIA, but you don't want to go into detail when your original meeting is to talk about an IUL, because what'll happen, you'll go down a rabbit hole and you won't get anything done. So when you book a meeting to talk to somebody about an IUL, And if you get on the conversation, just simply say, look, we'll schedule another meeting for that, because that's a whole deep dive in itself. So let's just focus on the IUL today. And then you write the IUL, you booked a meeting from a meeting, and you go back and you do the annuity meeting. I've just seen it so many times where a client wants to talk about both, and then at the end of the meeting, they're so confused, they don't do anything. So there's definitely a method to that for sure.
Well, we've got a lot of people that, they are leading with IULs, and I love that they are embracing the option of an annuity. It's a different product. There's an incredible niche for it. And it's just a really, I love them. I just think they really give people an opportunity to protect their money, but have an opportunity to participate in growth without ever losing it. I mean, for me, that's more of my personality. I want growth, but I don't want to lose it. I'm a little more conservative. And that's what an annuity is all about.